Every American has heard how strong the US economy is, but many feel like it's all an illusion. Commodities can actually answer a lot of these questions. Today, we're diving deeper into the hyperfinancialization of the American economy and what commodity prices can tell us about the deeper structure of the economic system. So, this is building a bit on the video we did on Triffin's Dilemma, where we looked at some issues with falling labor productivity. This is also building on a podcast I was just listening to with Mike Green, really smart guy, who was talking about commodity prices priced in gold and what that was indicating to him. And so that was kind of what spurred this. Many of you might be asking, what are commodities? Well, commodities are basically you can think of them as kind of the building blocks for further refinement into real productive industrial use, right? So there are many different sectors of commodities. There's energy, which includes things like natural gas and crude oil. There is softs, which are agricultural commodities like soybeans and wheat, corn, cocoa, coffee. There are metals, right? Base metals like copper and iron ore, and these sorts of things. These are commodities. They are the raw materials with which the economy, the real productive industrial economy, uses to create kind of finished goods. And so here in white, PPIAC, this stands for Producer Price Index, all commodities. So this is an index that actually goes pretty far back, that we have a lot of history for, and it includes gold, silver, all the different commodities, all into one metric. And so there's a number of things with this first chart here. What I want to point to is real GDP. I want to start with real GDP. So remember, GDP stands for gross domestic product. It is the aggregate economic output of an economic system. Real GDP adjusts for inflation, meaning this is the real inflation adjusted growth that we are getting in the economy. Remember, if the government prints $10 trillion tomorrow and spends it into the economy, that will show up as nominal GDP. But whether or not that causes real growth that real people can actually feel and benefit from, that's a different question, right? If inflation is really high, that needs to be factored in. And so that's what real GDP does. This adjusts for inflation. And what I want to point out here is since 2001, I drew this arrow, this kind of trend line. If you're a trader, this will look familiar. This lower highs, right, that have been being set by real GDP. Now, remember, the economy is cyclical. There are idiosyncratic things month to month, quarter to quarter, and it will vacillate, and we can see that. As it vacillates, like a EKG kind of looks like, right? But the general trend here is what's important. So in 2001, we had real GDP over 4.5%. And then in 2004, we had real GDP of about 4.3%. And then the next time we had a spurt of growth in 2010, it was 3.2. And then here, we were able to get back to like 3.6 ish. But then in 2018, right, the next kind of positive growth impulse only got us to like 3.1. And then the next one only got us to 2.9, right? And this most recent one only got us to about 3%. In general, this is lower highs, right? In general, this is kind of a downtrend. This is a resistance. You don't trade real GDP, but as a trader, you might see that. And I'm going to draw a trend line here at 2%, or try to get as close as, okay, there we go. So this red dotted line here shows real growth of 2%. Anytime this blue line is above the dotted line, you are getting positive 2% growth. And we can see that for the vast majority of the time, the American economy has had 2% real inflation adjusted growth. Okay, but what I want to do now is show 3%. So here I'm going to move the red line up to about 3%. And now look at the recent 20, 25 years, right? And look at all the time that we spent below 3%. Now go back pre 2000 and look at all the times that this blue line was above 3%. it was not uncommon starting in the 50s, which is, I think, as far back as this data goes. It was not uncommon to have very high, 3, 4, 5, 6, 7% real growth. The problem is we have not had that in a long time. We had this brief spike, right, which was very kind of idiosyncratic, and it was basically just noise, as was the steep drop off, right? It's important to evaluate the general trend with these things. But look at all the amount of time, starting in the 50s, that we had real growth at like 5, 6, 7%, certainly above 3%. And then look at, the past 20, 25 years. So that is point number one. Point number two is this red line, which clearly you can see has some correlation to the purple line. But the red line is the Dow Jones Industrial Average divided by gold. And so what this indicates, when the Dow Jones Industrial Average, which is a stock index similar to the S&P 500, when money is pouring into the Dow more so than gold, this red line will go up. And so sure enough, I highlighted this section from 1980 all the way through to like 2000, right? Where the Dow Jones, the numerator, outperformed gold. Put another way, this Dow Jones divided by gold gives you an inflation adjusted, again, not on a week to week or day to day basis, but on a many year long basis. It gives you a good idea of the real purchasing power and the real inflation adjusted gains of something. And we can see that the peak that it set in 2000, it has been trending down. And certainly, I mean, the inflation adjusted Dow Jones is at the same level it was at 10 years ago. We can see in the past 10 years, it has basically just gone straight sideways, and it has not come and retested that high. And the same thing is true for the producer price index, all commodities divided by gold. So this again is kind of like a way to adjust for inflation through using gold as a denominator. And we can see that the demand for producer for all commodities since 2000 has been in this very clear downtrend. It is steeper than the Dow Jones over gold downtrend. Um, but I think what's interesting is the degree of correlation that this had prior to 2000. Well, arguably, kind of the early 90s when globalization really took off. You can see it started to diverge kind of here in 1986. Financialization and globalization were kind of just taking off in the mid 80s, and we can see that for the longest time. Now, remember, gold was fixed as a price. So there's some difficulty in evaluating data prior to that, but in general, from call it the late 60s all the way through to the kind of start of financialization, you can see these two lines tracked where the real inflation adjusted returns of the Dow matched the real inflation adjusted returns of commodities. Hopefully that makes sense. And then finally, here in white, we have the producer price. Again, this is producer price index, all commodities divided by the Dow Jones, right? So when this white line is going up, this is indicating that commodities are becoming more expensive. So what I want to highlight was when the Dow outperforms gold, when commodities outperform gold, meaning that the demand for commodities is higher, the demand for real inputs is higher than the demand for monetary. I mean, arguably, gold is money, and everything else is just credit, as J.P. Morgan said. But this general concept of demand for commodities. If you are really trying to make useful, if the economy is truly booming and you're making real products and creating real value and real things, the demand for commodities will be higher than the demand for gold, right? Because gold is basically just a monetary asset. And we can see that. We can see that during these periods of relatively high growth, right, above 3% growth, especially kind of this particular in the mid 70s, we were rebounding kind of out of a recession. You can see that that's exactly what happened. This purple line goes up right? And it's hard to see here because of the issues with gold, but I take me at my word. It had increased here through to 1968. But we can see that the purple line goes up. What this means, demand for commodities is outpacing demand for money or monetary assets. Same is true for this period of time from 1980 all the way through to 2000. The demand for commodities was increasing faster than the demand for gold. And then here in white, we can see commodity demand for commodities relative to demand for financial assets like the Dow Jones. And what do we see? We see the demand for commodities is actually lower, right? The commodities index underperforms the Dow in those periods of time. So here is the S&P 500 divided by gold again in white. That shows us kind of a inflation adjusted S&P 500 because you're denominating in gold. And then again in purple we have commodities divided by gold. This is again the same two lines we were looking at here, right? Dow and S&P are very similar, both stock indexes. And then in red we have the fiscal deficit as a share of GDP. What I want to kind of illustrate is the correlation that this has to the real inflation adjusted commodity index. You can see this red line tracks right with the purple line. In my opinion, this is a strong correlation since arguably going back to kind of the mid to late 80s. Again, comes this period of time where we mentioned the divergence here. Remember between Dow and both the real Dow and the real commodities. Remember, these lines were tracking, and then they diverged in the mid 80s as financialization started to take off. We see that same kind of dynamic. There was not much correlation here between the fiscal deficit as a share of GDP and this real, inflation adjusted commodity index. You can see that there was not much correlation going all the way back to the mid 40s, all the way through until the mid 80s when financialization started to kind of really accelerate. Well, what happened? We see the fiscal deficit. Remember, this is the gap between what the government spends and what it collects in revenue. The fiscal deficit started to track this real inflation adjusted commodities price, right? We can see here for the period of time in the 90s, we can see that the fiscal deficit, right, as commodities increased in value fast, as demand for commodities increased faster than gold, demand for money, as Mike Green framed it, as that happened, we can see that the fiscal deficit improved, right? Remember, the fiscal deficit is this scale here, all the way to the right. So you can see this is when we ran a fiscal surplus. And, that kind of makes sense when you look at the real inflation adjusted price of commodities. Commodities were outpacing gold, right? The purple line was going up, meaning demand for commodities was higher than demand for money. And we can see that the S&P 500 did really well, right? The S&P 500 in inflation adjusted terms did very strongly during that same period of time, just as the overall, you could call it the fiscal health, right, of the government's finances in red, as we were able to run this surplus. Commodities, real useful products were in demand, or inputs for real useful products were in demand higher than gold. That makes sense. And it would make sense that the S&P 500, the financial index, right, is also reflecting that strength, which is sure enough exactly what we see. But this correlation, right, between the fiscal deficit as a share of GDP and the real inflation adjusted price of commodities only started at the same kind of financialization period of time, which was that early to mid 80s. That is the same time that commodities, the real inflation adjusted price of commodities, started to diverge. Now, remember, as commodity demand is lower than the demand for gold, right? That's what we've been seeing since 2000. We've seen this purple line fall. What that means is the demand for real inputs into real things has underperformed the demand for money. And sure enough, what do we see? We see the fiscal deficit getting worse, right? I marked here NAFTA and the China shock, which was when China was admitted into the World Trade Organization. I believe these are really important turning points, as we'll see in some of these later slides here. So here are a number of metrics, some of which we've already looked at. Here up top, again, I've marked NAFTA and China shock. Here up top is personal income divided by M2 money supply. Remember, this is the one of the broader ways of measuring the total money supply in the American economy. And then in yellow, we have GDP divided by M2. And what these show are the inflation adjust. This is another way of adjusting for inflation. You denominate by the money supply. So if the money supply, if personal income, which is exactly what it sounds, personal income, or gross domestic product, which is the overall health of the American economy, if they are growing faster than the money supply, you will see this white and yellow line go up. And sure enough, going back to the early 60s, this is the general trend that we see. We see this general outperformance where personal income is growing faster than the money supply. This means the average American, their purchasing power is increasing. And the same is true for the broader economy. We see GDP outpacing. Remember, you can print a bunch of money and get GDP, but if you are getting more GDP than the amount of money you're printing, this yellow line will go up. And sure enough, that's what we saw from the 60s all the way through to the early 2000s. We saw both the real economy in yellow and the individual American, seen in white. We see that both of them outperformed inflation, right? And when did that peak? That I marked here in NAFTA and China shock. Both of these two measures peaked in August of 2000. So call it like 9 months before China's admission into the World Trade Organization, like a year before China's admission into the World Trade Organization, and globalization really took off. And what do we see since then? Personal income might have grown. If you look at personal income on a nominal basis, the line goes up. It looks great. They'll tell you it's great. But when you adjust for the growth of the money supply, you are getting less and less purchasing power. Your personal income, the purchasing power of your income is going down. And sure enough, our GDP, the overall economy, is underperforming the money supply. What this indicates is we are printing money, trying to stimulate the real economy and getting less and less real return. And then down here we have some of the lines we've already looked at: producer price, all commodity divided by gold, Dow Jones divided by gold. Remember this purple and red line. When you divide by gold, you're trying to get a inflation adjusted metric, right? And again, note the correlation, how tight this was, and note when it started to diverge in the mid 80s as financialization really took off. But what I want to point out, I added this new one, which is in green. This is the average hourly wage divided by gold. And what we can see is that it tracked, remember, PPIAC divided by gold. This is telling, as that purple line is going up, demand for real things, commodities, inputs, demand for real inputs is outpacing demand for money. This is healthy, in my opinion. This is what a good, strong economy looks like. And sure enough, the average hourly wage increases faster than gold. Just very similar to what we saw here, right? Personal income increasing faster than the M2 money supply. There are two ways of measuring the same thing. Well, what do both of them show? The average hourly wage divided by gold peaked like 6 months after personal income divided by M2. Both the green line and the white line are inflation adjusted measures of purchasing power. And sure enough, what do we see? As demand for real inputs underperforms demand for money, as shown in the purple line going down, the average hourly wage is again, it might look like it's increasing in nominal terms and everything's great. The news will tell you everything's great. But when you divide by gold, which is a way to account for inflation, just as we did with the white line, just using different denominator, you can see that since 2000, the average American's purchasing, the average hourly wage and the purchasing power of that wage has been in decline. Look, The real value, inflation adjusted value of the Dow Jones Industrial Average peaked in 2000. The average hourly wage, right? You could get, I'll just make it very simple. You could get about 0.06 ounces of gold for 1 hour's work. Today, you can only get 0.01, right? Hopefully that kind of drives the point home. The real inflation adjusted value of the Dow, it peaked in 2000. Personal income divided by M2 peaked in 2000. GDP divided by M2 for the kind of broader economy, that peaked in 2000. Demand for commodities versus demand for money also peaked in 2000. Hopefully, this one chart kind of illustrates or is starting to tie some of these concepts together. And oh, I wanted to also throw this on. So unfortunately, we don't have the most data for this. This is late manufacturing productivity, and in the only we only have data from 1988 through to 2023. It looks like a annual data series. You only get data annually. But what I want to point out is again this downtrend, and look when it peaked. It peaked in 2001. This is the productivity for manufacturing, labor productivity for manufacturing. Okay, so this one is pretty crazy. So here is the S&P 500 and commodities, right? So the blue line is that all commodity index, and the white line is the S&P 500. And this data goes all the way back to 1913. And what I want to point out is this is just another way of looking at kind of this red line. It's just another way to present the data, but the blue line is commodities. The white line is kind of financial assets, the S&P 500. And what I want to show is that over, 5-10 year period, they relatively track each other. You can see that the price of commodities and the price of the S&P 500, generally speaking, track each other. When this starts to diverge, is the 80s when financialization really starts to take off. Here we're measuring from 1966 through to 1990, and we can see commodities increased 250%, the S&P 500 increased by 240%, right? They generally tracked. Well, what starts to happen? The S&P 500 starts to just dramatically run away from commodities. We can see, from 1994 through to 2018, the S&P 500 increased 520%. Meanwhile, the price for commodities only increased 67%. There's almost a 10x difference gap, right? And when you measure the totality of the data that we have, which is what this zooming way out, now we're measuring from, call it 1925 all the way through to 2027. So that on the longest term time frame that we can look at, the S&P 500 has increased 71,000%, which is a lot, but commodities have only increased 1,400%. This the degree to which the S&P 500 and financial assets started to just absolutely run away from the price of commodities. Remember, the price of commodities indicates inputs into real useful productive use, industrial production, the real useful productive economy. That is incredible. And so I wanted to measure the standard deviation. So what I did is I took the S&P 500, the exact same two data points we were looking at here. I took the S&P 500 and divided by the price of commodities. And then I found the standard deviation, right? And we can see that generally speaking, the S&P 500 relative to the price of commodities, it would have these minor zero point 0.2 standard deviation moves. And this goes back all the way till the 1920s. One of them might radically outperform the other. You'd get a little pop, right? The standard deviation would go to like zero point 0.2. Well, look what starts to happen in the mid to late 90s. Now you're starting to get one standard deviation moves. And look at what has happened since kind of mid 2010s. We can see at its peak a 2.3 standard deviation divergence between the S&P 500 and the price of commodities. Okay, So here's another really interesting kind of indication that this hyperfinancialization is what's the cause of this, right? That this is all connected. So here's the S&P 500 divided by commodities, right? We were looking at the standard deviation of moves of this white line in down here in red. That we have in white. And then in red, we have the net worth of the top 1% as a share of GDP, denominated in GDP. And then in green, we have the S&P 500 denominated in GDP. Remember, when this red or green line go up, the net worth of the top 1%, or in the case of the green line, the S&P 500 is increasing faster than GDP is growing, right? GDP, they both could be growing, but the numerator is growing faster than the denominator. Well, what do we see? I marked here the China shock. They have followed as demand for financial assets, as measured by the S&P 500, has outpaced commodities, meaning this white line goes up. What do we see? We see the S&P 500 relative to GDP track it almost identically. Again, there's divergence here pre-financialization, but post financialization in the mid 80s here, we can see that it tracks almost identical to the out. You can think of this white line as the degree to which financial assets are being preferred over real inputs into real things. That when the white line is going up, it is indicating more demand for financial assets than real things. Think of it that way. And sure enough, the net worth of the top 1% as a share of GDP and the S&P 500 as a share of GDP, a denominated GDP, they both track identically to the degree to which financial assets are being preferred over the real useful economy. And then here in yellow, I just threw down the balance of trade, inverted. Remember, here's NAFTA. We were running a $8 billion trade deficit in 93, 94 before NAFTA. Prior to the China shock, we were running about $28 billion trade deficit. Well, we can see that number is now $140 billion. And hopefully it is clear the correlation between this balance of trade, especially post financialization, in the 80s here, the correlation to the net worth of the top 1% and to the degree to which the S&P 500 outperforms GDP. Remember, this balance of the inverted balance of trade, the other way you can think about this, an inverted current account deficit is a capital account surplus. This is the amount of demand, well, the current account, which is about $100 billion a month, that is demand for financial assets, right? For this white line to outpace commodities, for the net worth of the top 1% who own all of their wealth in financial assets as measured by the green line, right? So hopefully that connection is clear by now. I've hit it many times in many of the videos. And then finally, I want to end here. Here in white is commodities divided by Dow Jones. And then in red, we have gold divided by Dow Jones. And again, what I want to point to is the degree to which this correlation held leading into the mid to late 70s. And look at the trend that has changed from, say, 1980 or mid 85. Look at the degree to which commodities have underperformed financial assets as measured by the Dow Jones. And look at the degree to which gold has underperformed the Dow Jones. You can see this delta, right? Look at how tightly this tracked. You can see this starting to widen. Well, what is that indicated? The denominator is both the same thing, right? The Dow Jones Industrial, financial assets. Well, the red line, remember, the red line will go up if the demand for gold outpaces the demand for financial assets. We start to see a pretty clear trend change where commodities are being less and less preferred over the Dow Jones, and gold is being preferred more and more over the Dow Jones, over financial assets. This is one of the many reasons that I am bullish on gold and therefore Bitcoin. They are both scarce assets that do well in currency debasement. They do well in kind of profligate spending, and they do well in times of uncertainty. And so here in the lower pane, we have the 10-year yield, and then we have inflation year over year. Remember, the way you feel inflation is the CPI index, which is a line that goes up and to the right. But the way that economists measure inflation is this year over year change, which is what we see here in blue. And a couple things I want to point out. So here in 1917, 1918, we had sustained inflation up at 17, 18, 19, 20%. A lot of people point to World War II, right? The last time debt to GDP was this high was World War II. So let's look at World War II. How did we get out of 120% debt to GDP? Well, we kept rates really low, right? Here, as seen in purple, we kept the 10-year treasury, even though inflation was running at 19%, we kept the 10-year treasury at 2.5, right? That difference is called financial repression. You are running it hot, you are inflating the debt away. This is financial repression, and this is how countries get out of debt issues. But what I want to point out is these periods of time where commodities outperform, right? Where gold outperforms financial assets. Look, from the kind of mid 60s through to the early 80s, which is again this period of time I keep coming back to, I keep drawing this parallel, this analog to the mid 60s through the 80s. What did we see? We see the demand for commodities as measured by the white line outperform the Dow Jones, right? This white line goes up. And we see the demand for gold specifically, which is kind of, right? Gold is a commodity, but gold is also a monetary hedge against currency debasement and high inflation. And we can see gold outperform the Dow Jones Industrial Average during that same populist era from 65 to 82. And all you got to do is look down here. I'll try to draw a box. Hopefully this is pretty clear to see here. But this period of high inflation where commodities are outperforming financial assets, where gold is outperforming financial assets, look at what rates are doing. Look at what the inflation rate is doing, right? Like the 70s were marked, and here in 1974, inflation was as high as 10, 11, 12%, right? This is, high inflation. I am not in the hyperinflationist camp, but sustained 10% inflation, that is brutal if you are an everyday American. Well, look at what happened, right? Rates went up, bond yields went up. This is what bonds are supposed to do. They're supposed to, price in inflation and growth, nominal growth. But look at what outperformed financial assets, gold and commodities. Now it's important to remember when demand for commodities is high, right? This can lead to high prices, especially if supply is constrained. So this is part of what drives the dark blue line higher, right? With inflation, you can see this dip. I will try to draw the box a little tighter to really hone in on this concept, which is commodities started to underperform financial assets, right? The demand for commodities might have been increasing, but it was increasing slower than the Dow. And commodity prices came down faster than Dow Jones, than financial assets. Look at what happened to inflation here in dark blue. We can see inflation declined. Remember, commodities are the input for basically everything. When commodity prices are running hot and the demand for real inputs is increasing, that can be inflationary, but it doesn't necessarily have to be a bad thing, right? Again, going back to this chart, which shows the average American's health, right, as measured in white or measured in green, right, which is just two ways of looking at the same thing, we can see that, look, the average American's wages from 1965 through to the early 80s increased notably, right, as measured by the white line here. So high inflationary environments do not inherently mean that the average everyday American is losing out. I understand that the recent experience for most of us has been absolutely brutal when it comes to inflation. But historically speaking, there are periods of time where rates are moving higher, nominal growth is moving higher, commodities are outperforming, right? All these things, and inflation is higher, but the wage gains are even higher than that, right? So if you have 5% CPI inflation, but your wages are growing at 10%, which is basically what we saw here as this white line goes up, Now, the green line measures because it denominates in gold. The Nixon shock is, a bit of a kind of issue there with the green line. But here in personal income, denominating in the actual money supply, you can see that uh, you know I do not expect something like this to happen. If personal income, as long as there's no gold revaluation, when personal income outpaces M2, generally speaking, today, you can expect average hourly wage to outpace gold. This sharp drop in the green line is simply because of the denomination in gold and the fact that what happened here was gold. Was suddenly we abandoned the gold standard and gold skyrocketed. But here in white, you can see that there are periods of time where the average American's wages can grow faster than either M2 money supply or gold, which measures loosely, especially over longer periods of time, inflation. And that's kind of what we see here, right? In this period of time where demand for commodities was outpacing demand for financial assets. That is not good for the top 1%, generally speaking. As we can see, that is definitely not good for the Dow Jones Industrial Average. When demand for gold is outpacing demand for financial assets like stocks. Uh, and so I'm not saying 100% this is exactly how it will happen again, but hopefully all these kind of data points presented in this way um, can indicate, can help inform your view. I really think that this chart is extremely. I mean, I use personal income over M2 and GDP over M2 to show this silent depression I keep talking about. If the economy was so great, why have the average American's wages declined from 0.06 ounces per hour to 0.01 ounces per hour? Put another way, your work today, you would have to 6x to get back to the real purchasing power of your wages in 2001, right? Because this is measured in ounces of gold. 1 hour of work is still 1 hour work here, and it's still 1 hour work here. Gold's value did not change. But in 2000, 1 hour work got you about 0.06 ounces. Now it only gets you 0.01 ounces. Why has the average American's wage been falling in real inflation adjusted metrics for 20 years if the economy is so hot? If the economy is so hot, why has the Dow gone basically nowhere? And why has it not set a new high in 25 years? So, again, hopefully all of this was helpful. Uh, any thoughts, please leave a comment as always. I'll try to respond to all of them. Catch you in the next one.